morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. What I'd like to talk about is state of the equity markets. And basically the big question is this a breakdown in the markets or is this just another Brexit moment? And what I mean by that is the Brexit moment, it was an unexpected event when the British voted on the referendum to leave the European Union, and no one thought they'd do it. They voted to leave, the market got killed and then rebounded with no consequences at all after that. So pretty much that's what's going on as we head into our election. The S&P and all the general indexes have been down for 9 days in a row, and it's been really pretty ugly. All the major indexes have gotten below their 50-day moving average. However, there are some positives is that they did bounce off the 200-day moving average. We saw it in the small caps, which were leading. We're just doing terrible over the last few weeks. However, we did see a little bit bounce even on Friday after a 200-day. And of course, we got a big rally going on this morning. The spin on it is that because the FBI won't indict Hillary, that's positive for the markets because they'll be getting a known more of the same. But we'll get back to that a little bit later. So that's kind of interesting that all these indexes breaking down, but we're getting a big bounce here. So did our Brexit moment already occur last week and we're seeing the bounce back? Even though the election's still looming this week, it's all to be seen. Now, some of the other kind of negative things we've seen in the market is leading stocks have broken down pretty hard. And what I mean, stocks like Facebook, Amazon, Alphabet, Apple, all kind of broke down through their 50-day moving average. Still above the 200-day moving average. That's still a good thing. But generally, when you see that many leaders breaking down, it tells you to be a little bit cautious. Now, usually these scenarios always tell us that this is the end of the world. And usually we know it's not. And some of the positive things going on here need to be looked at. Specifically is the financial stocks. Financial stocks are doing very well. We don't go into a recession and we don't get a bear market with financial stocks being pretty much a leading sector. Similarly, we see the transportation sector doing very well also. And those two sectors leading tells us that we're probably not going into a bear market, probably just experiencing a correction, and again, maybe a Brexit type moment. Also, coming into today, the sentiment is extremely negative, and that's a great contrarian indicator. Meaning all last week we saw the put-to-call ratio spiking above 1.1. We hit 1.43 in a closing basis one day, 1.37 I think on Friday. Intraday as high as 1.57. Tells us that people are buying insurance. They're so nervous they're buying more puts than calls. Also, if we look at the American Association of Individual Investors at their bullish-bearish sentiment, and we average it out over the 52 weeks, levels we're seeing now are the lowest we've seen since 1990. And of course, we had a great market after that. And these are the kind of levels we see at market bottoms, not near market tops. We're off a few percent. So that sentiment tells you it's a good contrarian indicator that this market may have lots of room to run, no matter who wins the election. Similarly, if we look at what are the chances of recession at this time, very low as well. The yield curve is steepening. It's a very good thing. You don't get in a recession with a steepening yield curve. Also, global growth is going on around the world. It may not be as fast as you like it, but if you look at the global purchasing managers index, PMIs, so far you'll see that pretty much all the Western countries are expanding and improving from September to October. So with that, chances of something catastrophic happening isn't going to happen. Okay, at least not at this time. Now, looking at the election. Historically, if we look at the past election, the election pretty much did nothing to change the direction of the market. Meaning if we're in a bear market, whoever was elected, whichever candidate, the market continued in the bear market. Usually we're in a bull market, and no matter who won the election, whether it was a surprise or the known, the market pretty much continued. There was some volatility during that time, but the market pretty much continued along those ways. So lastly, there's going to be a lot of spin, who's better for the markets, and the spin is that Hillary's the known, so markets won't get any surprises. Donald Trump's, of course, the wild card, so the sentiment is that if he wins, markets will do terrible. However, this may not be true because most of his policies are pro-growth. He has a few crazy ideas on protectionism, but generally, though, with cutting regulation, cutting taxes, and more pro-growth type stance, he might be just as well. So it's going to be a rough ride these next few days. Let the price and volume be your guide. The thing is, don't panic. Watch the indices and have a great trading week. This is George Kachuk, or RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago.